There are 3 fatal market structure mistakes that are secretly draining your trading account, and most traders make them. The scary part is that you might be doing it yourself. So in this video, I'm going to cover 3 deadly market structure mistakes you're making and how to stop them before it wipes out your profits. So if you're serious about trading, stick around, because this video could be the difference between consistency and emptying your account. So first of all, what is market structure? Well, market structure is just the way markets move, and it usually has 3 distinct phases. The first is an uptrend, so higher highs and higher lows. Next is a downtrend, so lower lows and lower highs. And in between, there's usually a consolidation, so a sideways market, which acts as a transition between the two. And this is universal to any market. You have to bear in mind, price moves in waves. It doesn't just go up in a straight line, as there has to be some sort of a balance between buyers and sellers, because trading is an auction process. We should start with market structure, so naked price action, so we don't miss obvious trends on the chart. It's like having a pen behind your ear and then forgetting where the pen is. Within uptrends or downtrends, there are usually 2 phases, impulses and corrections. Impulses are the pro-trend move. For example, when buyers step into the market, this pushes the market up, which is the impulse. When the buyers take profit, this leads to a pullback or correction. When the buyers step in again at a more favorable price, this leads to a further impulse, which pushes up price further. But if it's that easy, then why do so many traders struggle? Here's why. The first is a lack of understanding of structural shifts, which just leads to FOMO. As mentioned earlier, price moves up in waves, and we can actually enter on the pullbacks for a better entry. But a lack of understanding of core market concepts like breakout structure or change of character causes many traders to FOMO and lose money. So let's go to the charts to cover this in more detail. So looking at this 4-hour Australian dollar USD chart, we can see that there's a massive downtrend here. And if we zoom in on this current price action, this was a low here, this was a lower high here, and this was a push down. Now, if you look at this bearish candle here, this red one, this was the actual close below this low here. And this is what we call breakout structure, because the lead-in trend was bearish. And we're actually continuing this with lower low, lower high, and lower low. Now, of course, this was a low, but this low didn't change anything. It was actually this close below that led to the continuation. And then you can see there's a push down, a push up, and then another push down here. And so here, you can see that it was this close below this low, this bearish price action, that led to another breakout structure. And again, of course, we had these lows here, but these didn't change anything. And this was the major lower high. Now, then we can see price is now reversing. Now we have to actually get above this major lower high for us to say, okay, this is a change of character. And a change of character is when there is a reversal. So if the lead-in trend here was bearish, so lower lows and lower highs, it's that transition point between higher highs and higher lows. And whilst you could argue that this is a high, of course it's a high in the lower time frames, but it was actually this high here that we got the close above this high that we needed for us to say, okay, this is a change of character. And so similarly, we had a push up and a push down and then a push up. So this is now a breakout structure, because now the newly established trend is an uptrend. And so you can see this is a higher low and this is a higher high here. And this initially was a liquidity grab. Like all we did was sweep this liquidity. And I cannot stress this enough. For me, there has to be a close above for me to say it's a breakout structure. And the breakout structure actually officially happened here. So understanding the difference between breakout structure and change of character will really help you to trade with the overall 4-hour bias and not counter trend, which has a higher chance of losing. For example, if you can see here, there is an uptrend now. So higher high, higher low, higher high. Now, if you trade a counter to that on the 15-minute time frame, so shorts on the 15-minute, you're more likely to lose as opposed to entering longs on the 15-minute. And if I was to map this out using waves, it would be like this for me. So push down, push up, push down, push up, push down, push up, push down, push up. And as you can see, real life is very different to textbook, because of course this was a high as mentioned earlier, but it was actually this high that closed above here for us to say this is a change of character. And this leads me to the second fatal mistake, which is misreading highs and lows. See, markets move across various time frames, making it easy to get caught in the trap of picking the wrong low or high. And this is a common mistake that many clients make before coming to me for help. And I think a key tip is to understand the difference between external structure, which is the much bigger overall move, versus internal structure, which is the smaller move within the big move. So looking again at the 4-hour Australian dollar USD chart, we had this massive push down leading to this low. And this was a major swing low. So I would call this an external structure. Then we have this push up, and that is a lower high. Again, an external structure and a swing point. Then we have this push down here. Now, this bearish candle close was actually responsible for closing below this low. And so I would actually label this as the major swing low here. And again, this is an example of external structure as well. Now, you can see in between, there is all of this noise here. And I would actually label this as internal structure. And you can see here, if you just stuck to the major swing points, you would really simplify your trading. And of course, you can trade this internal structure on lower time frames. So for example, the 1 hour or the 5 minute. But if you stick to the external swing points, it will substantially simplify your trading. Then we have this push up here and then push down here. Now again, whilst this was a valid low, you can see it was actually this close below here that actually closed below this major swing point. So for me, the external structure is this lower high. Similarly, we had this push up here again, push down, then a push up and push down and a push up. Now, for us to say it's a change of character, so a change in trend from bearish to bullish, I would say we actually have to get a close above this major high. Again, this is an external structure. Yes, we got this push up here, but in the grand scheme of things, this high here did not actually change anything in terms of structure. But of course, in the lower time frames, it might be significant. And similarly, we got this push up here and then push down and then this push up here. And it was actually this close here that actually closed above this major higher high. So once again, I would put the major external structure here. So this as the high high, as this was the highest point. This was just a liquidity grab. And in between here, again, we've got internal structure. Wait, you at the back, what did you say? Oh, you want another example? Sure, let's look at gold USD 4-hour chart. So here you can see we've got this push up here, and this is a higher high because we broke out of this high. And then we got this higher low here, which is higher than this low. And then we got this push up here. Now, I would classify this as the major swing point, so external structure. This is external structure here. And this is the major swing high here as external structure. Of course, we had all this price action in between, like here and here. But for me, this is internal structure. It didn't actually change anything because we had to actually get above this major higher high. So as you can see here, for us to say, okay, this is a break of structure. And so when you keep trading simple, especially on the 4-hour time frames, you can look at the broader move because a lot of people overcomplicate trading. They try to look at the lower time frames, especially this internal structure, and they end up picking the wrong higher high or higher low, which just leads to a mess for them. The rule of thumb for me is that if the structure was not responsible for causing a break of structure or a change of character, it's not as important. And so as you can see, this is the major swing high. We had this push up and this close above. This was a break of structure. Then we actually formed this sideways consolidation because this was the major higher high and this was the major higher low here. But none of this price action actually changed anything. We didn't actually close above this major higher high. And it was only at this push up here, this close above here, we actually closed above this higher high. And so this, for me, was the break of structure. And if you're going to start trading this internal structure, this messy sideways price action, you can get chopped up, especially when there's no clear direction. And so we got this push up here and then push down. And so this, for me, was a higher high. This was a higher low. And once again, this internal structure here. And of course, on the lower time frames, you can trade this. But it was actually this push up here, this close above here that actually led to this break of structure. The major swing point is this one, higher high. This is the higher low. And of course, we got the higher high here as well. And rule of thumb that you can use when you're not sure about picking the right high or low is to ask yourself, did the structure actually be responsible for causing a break of structure or a change of character? And so you can actually use break of structure, change of character to validate each single high and each low. And of course, trends do live within trends. For example, here we got this push up here. This is a higher high, and then a push down here. This is a higher low. This is a push up here, a lower high. Now, it was only once we closed below this low can we actually say this is a lower high. And of course, we've got these smaller trends in here. But you can see the 4-hour move in general here. It's starting to be bearish now. Initially, it was an uptrend.
A key takeaway for you is to view the market as waves. And when in doubt, zoom out. Instead of focusing on every small move up and down, try and focus on the much bigger picture so you don't get stuck in all the noise. The final fatal mistake is the failure to recognize the fractal nature of the markets. The markets move in such a way that the patterns on the higher time frames are actually reflected on the lower time frames. For example, you could have a bullish 4-hour uptrend, but within that move, there could be a bullish 15-minute uptrend, which could be a valid setup on its own. And you can actually enter trades on the lower timeframes to fine-tune your entry. But of course, the lower timeframes are a bit noisier, but with enough exposure, you will get better at it. Trading is a bit like driving. You developed a road sense, sure, by passing the driving test, but mostly by getting practical experience on the road. Similarly, as you get more experience in the markets, these concepts will be more familiar. If you're new to markets, I highly recommend sticking to trending markets and trading with the trend, because they do say that the trend is your friend, which is true to some extent. Consolidation sideways markets can be a bit more choppy and are a bit more advanced, but you will get better at this with time. And please don't just consume the information that I've presented in this video. Try and actually apply it on practical chart examples. But of course, don't trade purely based on market structure, but rather use it as confluence with other things. But of course, market structure is the foundation of any trading strategy. It's not the indicator that makes a trader, it's the trader that makes a trader. And if you like this video, then you will love my previous video, which will help to fast track your trading journey and avoid costly mistakes.